Hello, I'm SA, your AI essayist. Please note that all content, audio and video in this presentation are AI generated. As AI can sometimes produce inaccuracies, I encourage you to verify any factual information presented. With that in mind, let's begin.
The intricate architecture of economic relationships frequently encounters a foundational challenge aligning the interests of parties when one possesses information or takes actions hidden from the other. This pervasive dilemma, central to understanding everything from corporate governance to labor markets, forms the bedrock of what economists term the principal-agent problem. It describes a situation where one individual, the principal, delegates authority or tasks to another, the agent, whose subsequent effort or information is observable only partially. Bengt Holmström's early intellectual endeavors plunged directly into the heart of this complexity, seeking to construct a rigorous framework capable of dissecting and addressing the economic consequences of such information asymmetry. Prior to Holmström's seminal contributions, economic theory acknowledged the existence of incentive issues. Certainly, A.D.M. Smith's observations on the diligence of proprietors compared to their managers hinted at the core conflict centuries ago. Yet, the formal modeling of these interactions under conditions of significant information disparity remained relatively undeveloped. Models often operated under simplifying assumptions, perfect information, or incentive structures derived from aggregate, easily verifiable outcomes. A deep, micro-founded analysis of how individuals respond strategically when their actions are hidden from view and how contracts could be optimally designed in such environments represented a significant frontier in economic thought. The field needed a more precise language, a more powerful analytical toolkit, enabling movement towards specific, testable predictions and prescriptive advice for contract design. At the core of the principal-agent problem, and a specific focus of Holmström's initial investigations, lies the issue of moral hazard. This arises precisely because the principal is unable to directly observe the agent's effort level. Consider the classic scenario of a firm owner, the principal hiring a manager, the agent. The owner wants the manager to exert high effort to maximize profits. The manager, however, might find high effort costly or lacks inclination for it and may prefer to shirk, especially if shirking remains hidden. The owner observes the firm's profit. Profit represents a noisy signal. High profit could result from high managerial effort, or it could stem from favorable market conditions entirely outside the manager's control. Low profit could reflect low effort, or arise from bad luck. The difficulty in perfectly disentangling the impact of effort from the influence of random external factors creates the moral hazard. The agent has an incentive to behave in ways detrimental to the principal's goals because their actions are hidden. This unobservable effort dynamic permeates countless economic interactions. An insurance company principal faces moral hazard with its policyholders' agents. Once insured against loss, an individual might exercise reduced care to prevent that loss. A venture capitalist principal funding a startup founder agent worries about the founder's dedication once the investment is secured. A patient principal relies on a doctor agent to recommend necessary treatments, trusting the doctor acts in the patient's best interest despite the information imbalance. The problem is fundamental. It touches upon trust, accountability, and the very possibility of efficient cooperation whenever information sharing is imperfect. The economic landscape of the mid to late 20th century, as Holmström began his work, recognized these practical challenges. Corporate structures were growing, separating ownership from management. Financial markets were becoming more complex, involving intricate relationships between investors and fund managers. Public services grappled with motivating employees whose output proved difficult to quantify or monitor. Existing economic models, while sophisticated in areas like market equilibrium or macroeconomic dynamics, provided insufficient guidance on the micro-level design of contracts to mitigate moral hazard effectively. Standard labor contracts often offered fixed wages. This provided minimal incentive for effort exceeding the level necessary to retain employment. Simple profit-sharing arrangements existed. These arrangements provided no rigorous basis for determining the optimal share or understanding how external noise affected incentives. Developing a framework capable of addressing this necessitated incorporating a formal mathematical approach. It demanded a formal mathematical approach to model agent preferences, the technology linking effort to outcomes, the nature of the uncertainty involved, and the principal's objective function, typically profit maximization or cost minimization. The challenge involved formulating the problem as an optimization exercise. How should the principal design a compensation contract? A function mapping observable outcomes to agent pay that induces the agent to choose the desired effort level while simultaneously minimizing the principal's cost or maximizing their expected payoff. The difficulty lay precisely in the unobservable effort. If effort were perfectly observable, the principal could contract directly on effort, paying a high wage for high effort and a low wage for low effort. The problem vanishes. When effort remains unobservable, the contract must rely on signals correlated with effort, such as output or profit. These signals are also influenced by factors outside the agent's influence. The agent's compensation becomes contingent on this noisy signal. This introduces risk for the agent, as their pay fluctuates with factors separate from their effort. Since agents are typically assumed to be risk-averse, they find this variability undesirable. An optimal contract must therefore balance two competing objectives, providing incentives for effort which requires making pay sensitive to the noisy performance signal and ensuring the risk-averse agent against uncontrollable fluctuations, which suggests making pay exhibit reduced sensitivity to the signal. This tension between providing incentives and insuring against risk was well understood qualitatively. A formal, general model capable of precisely characterizing the structure of optimal contracts under varying conditions of risk, information structure, and agent risk aversion remained undeveloped. How should the sensitivity of pay to performance be determined? What performance measures should be included in the contract? Could multiple signals, each containing some information about effort, be optimally combined? These questions demanded a rigorous analytical foundation. Holmström's work began to furnish this foundation. He recognized the need to treat the principal-agent relationship as a sophisticated contracting problem under uncertainty and asymmetric information. His approach involved formalizing the agent's decision problem, choosing an effort level to maximize their expected utility, given the compensation contract, and the principal's problem, choosing a contract to maximize expected profit, taking into account the agent's rational response. This required deploying tools from microeconomic theory, game theory, and the economics of information. The fundamental challenge he tackled involved understanding the informational content of various performance measures. When an agent's effort is hidden, what observable data points provide the most leverage for inferring that effort and constructing effective incentives? Profit represents one such data point. Sales figures offer another. Market share provides a third. Even measures seemingly unrelated to the agent's direct output, such as the performance of competitors or the overall state of the industry, might contain information about the difficulty of the agent's task or the influence of common external shocks. The crucial insight would involve discerning which signals, among the multitude available, were truly informative about the agent's unobservable actions and how they should be incorporated into a compensation structure to optimally balance incentive provision with risk sharing. This foundational problem, the design of incentive schemes under conditions of hidden action and noisy performance signals, defined the starting point for Holmström's profound impact on economic science. The challenge demanded a new perspective. The conventional approach centered on linking compensation directly to the agent's observable output, the final result seemingly reflecting their effort. This output is inevitably contaminated by factors beyond the agent's control, external shocks, market fluctuations, unforeseen events. Tying pay solely to this noisy outcome forces the agent to bear significant risk. A good outcome might be luck. A bad outcome might stem from unavoidable adversity despite high effort. Principals face a dilemma. Strong incentives require making pay sensitive to outcomes. This sensitivity simultaneously exposes the agent to undesirable risk, requiring higher compensation on average to compensate for that risk bearing. This tension, the fundamental trade-off between providing incentives and insuring the agent against risk, lay at the heart of the principle's problem. Holmström's seminal contribution, the Informativeness Principle, offered a powerful resolution to this dilemma. His insight extended to include considerations beyond output alone. He demonstrated mathematically that an optimal incentive contract should incorporate any performance measure that provides additional information about the agent's effort. The crucial criterion for inclusion is whether observing the measure changes the principal's belief about the agent's unobservable effort level. Consider the economic landscape of the late 1970s and early 1980s. Agency theory was developing, grappling with how to align the interests of a principal, for example a firm owner, with an agent, for example a manager, when the agent's actions are hidden. Models typically focused on output as the sole signal. Holmström's work, notably his 1979 paper titled Moral Hazard and Observability, rigorously established the value of supplementary information. He formalized the principal's problem as minimizing the expected cost of compensation while ensuring the agent chooses the desired effort level and is willing to participate given their risk aversion. The agent's compensation, represented as a function of observable signals, needed careful construction. Holmström's key results showed that if an observable variable, let us call it y, exists alongside the standard output variable, say x, then y should be included in the compensation contract if and only if y provides additional information about the agent's effort level. This holds even if the agent possesses zero control over y. The condition for y's informativeness is formalized through conditional probability distributions. If the probability distribution of observing both x and y, conditional on the agent choosing a specific effort level A, differs from the probability distribution of observing x and y conditional on a different effort level a prime, then y is informative about effort A. Put simply, if seeing y helps the principal better distinguish whether the agent worked hard or shirked, then y is a valuable signal for incentive design. This principle profoundly altered the understanding of optimal contracting. It implied that principals should cast a wide net for performance data. Profit figures remain important, certainly. Divisional sales relative to industry averages might also serve this purpose, as could the performance of a competitor facing similar market conditions, or internal process metrics that correlate with effort even if they are intermediate steps removed from final output. Each of these potential signals, if informative about effort, can help the principal refine their estimate of how hard the agent worked, disentangling effort from luck. Let us delve into a classic application of the Informativeness Principle, relative performance evaluation. Imagine a company with several divisional managers, each operating in different geographical markets subject to common macroeconomic shocks. Evaluating a manager using their division's absolute profit as the single metric exposes them significantly to these market-wide fluctuations. A recession, for example, might depress profits across all divisions regardless of managerial effort. A boom might inflate profits even with mediocre management. Holmström's principle suggests incorporating the performance of peer divisions or even competitors into a manager's compensation. If a manager's division performs significantly better than average for that specific period, it is a stronger signal of high effort and high absolute profit during a widespread boom. Similarly, if a division performs only slightly below average during a deep recession, this might indicate strong effort despite adverse conditions. By comparing performance against a benchmark affected by similar external factors, the principle can filter out the common noise, obtaining a cleaner signal about the manager's individual contribution. The mathematical structure behind this involves updating beliefs. The principle begins with prior beliefs about the agent's effort. Observing the outcome updates these beliefs via Bayes' rule. The informativeness principle states that any signal enabling a more precise or accurate Bayesian update regarding the agent's effort should be utilized in the compensation formula. The optimal contract then sets the agent's pay as a function of these informative signals, structuring the function to balance the incentive effect, making pay sensitive to perceived effort with a risk-sharing effect, avoiding excessive exposure to uncontrollable noise. The benefit of using multiple informative signals lies in improving the efficiency of the incentive-risk trade-off. With a cleaner signal of effort, the principle can offer stronger incentives, making pay more sensitive to performance, while avoiding unduly increasing the agent's exposure to uncontrollable risk. The agent receives compensation more directly tied to their effort, with random fluctuations influencing pay to a lesser degree. This leads to a more efficient outcome from the perspective of both the principal, who faces a lower expected cost for a given effort level, and the agent, who enjoys higher expected utility for providing that effort. The implications of the informativeness principle extend far beyond executive compensation. It underpins the design of performance evaluation systems in numerous contexts. In sales, comparing performance against regional averages or overall market growth provides a more nuanced picture than raw sales figures alone. In project management, tracking milestones and intermediate deliverables, even if the final outcome is subject to external dependencies, can provide valuable signals about the team's effort and progress. In public sector performance management, comparing a school's test score improvements to those of similar schools in similar districts helps isolate the school's effectiveness from demographic or socioeconomic factors. The principle highlights that information has economic value, specifically in its capacity to reduce uncertainty about unobservable actions. Collecting and processing additional data points about performance becomes worthwhile if they are informative about effort, even if acquiring this information incurs costs. This spurred significant research into the optimal aggregation of multiple performance measures and the design of complex compensation structures. Holmström's work on the informativeness principle provided a rigorous framework for understanding which performance measures matter and why. It advanced the field, establishing a richer understanding of how information structures influence optimal incentive design, moving past reliance on simplistic models using single, noisy output signals. This foundational contribution laid essential groundwork, revealing the power of leveraging all available data to better align incentives and manage risk in settings where information is asymmetric. It provided a powerful lens through which to view existing compensation practices and a guide for designing more effective ones, setting the stage for exploring even more complex scenarios involving multiple agents and tasks. Building upon the rigorous analysis of single-agent incentive problems and the value of information, inquiry naturally turned to scenarios involving multiple individuals. The collective endeavor presented distinct challenges, introducing complexities requiring approaches different from the elegant solutions derived for isolated agents. A fundamental difficulty arose when multiple agents collaborated towards a common goal. The aggregate outcome was observable, and disentangling each individual's precise contribution proved impossible. This scenario, prevalent in partnerships, work teams, and even larger organizations, encapsulated the problem known as moral hazard in teams. The core issue resided in the divergence between private costs and shared benefits. Each member of a team incurs a personal cost when exerting effort. However, the fruits of that effort, the team's output, are typically shared among all members. If an individual's effort level remains unobservable directly or imperfectly inferred from the shared outcome, a powerful incentive emerges for each person to reduce their effort, knowing that the impact on their share of the output will be diluted by the efforts of others, while their own cost reduction is fully realized. This phenomenon, often termed the free rider problem, posed a significant barrier to achieving collective efficiency. Conventional principal agent models, focusing on a single agent contracted by a single principal, offered limited guidance here. The structure of incentives in a team setting, with the reciprocal externalities among agents and a shared output, demanded a distinct analytical framework. Bengt Holmström, in his seminal work on this topic, provided such a framework, offering a stark and insightful characterization of the problem's inherent difficulties. His analysis revealed a profound conclusion: achieving a first best outcome, where agents exert the socially optimal level of effort, presents substantial difficulty in a team setting under standard assumptions of risk aversion and unobservable individual effort. This outcome becomes attainable only when specific structural conditions are met. The key insight centered on the budget balancing constraint. If the sum of the payments to the agents equals the total output of the team, The arrangement lacks a party positioned to absorb the residual risk or bear the full marginal cost of any individual shirking. Any scheme that distributes the entire output among the agents creates a situation where the cost of one individual's reduced effort is spread across all members, including themselves, in their diminished share of the total output. This diffusion of responsibility and consequence means no individual faces the full penalty for their own reduced effort, perpetuating the free-riding incentive. Holmström's solution, framed as a characterization of the conditions enabling efficiency to be approached, highlighted the critical role of a residual claimant or budget breaker. This external party, who receives the difference between the team's output and the payments made to the agents, which could be positive or negative, effectively absorbs the collective risk and faces the full marginal impact of changes in total output. Consider a partnership structure where one partner takes on the role of the firm's owner, paying salaries to others and retaining the profits or losses. This owner, as the residual claimant, internalizes the full cost of any team member's reduced effort to the direct impact on the bottom line. This structure aligns incentives more effectively, albeit often at the cost of imposing significant risk on the residual claimant. The analysis underscored that standard contractual arrangements distributing total output among agents will inevitably fall short of first best efficiency due to the inherent public good nature of effort within the team context. The model demonstrated, mathematically, why partnerships without a clear hierarchical structure or external monitoring mechanisms frequently struggle with suboptimal effort levels. The power of this contribution lay in its rigorous proof of an impossibility result under certain conditions, forcing a deeper understanding of the fundamental constraints on incentive design in collaborative environments. It explained, with elegant precision, why ownership structures and hierarchical monitoring emerged as common organizational responses to the team moral hazard problem. The implications of the work on moral hazard in teams resonate powerfully in contemporary organizational design. Modern businesses heavily rely on teams for innovation, project completion, and operational efficiency. Understanding the inherent free rider problem is crucial for designing effective team-based compensation schemes. Simple profit sharing or bonus structures tied solely to team output often prove insufficient. Holmström's analysis suggests the need for mechanisms that emulate the residual claimant principle, perhaps through peer monitoring, relative performance evaluation within the team, though this introduces other complexities or linking team bonuses to individual contributions where feasible or structuring ownership stakes. The model provides a theoretical underpinning for the challenges faced by cooperatives or purely egalitarian organizational forms when scaling up, and conversely, the incentive advantages conferred by structures featuring concentrated ownership or strong leadership capable of monitoring and sanctioning. It offers a lens through which to analyze the success and failure of various team incentive strategies observed in practice, from startup equity splits to large corporate bonus pools. Holmström's analytical gaze extended from the challenge of multiple agents pooling effort towards a single outcome to the complications arising when a single agent undertakes multiple tasks. This scenario, ubiquitous in virtually every profession, introduces a different dimension of complexity to incentive design. Most jobs involve a portfolio of responsibilities, some easily quantifiable and measurable: sales volume for a salesperson, lines of code written for a programmer, number of procedures performed for a doctor, and others significantly harder to measure or verify: quality of customer service, maintainability of code, quality of patient care, collaboration with colleagues, mentoring junior staff. The problem arises when incentives are tied disproportionately to the easily measurable tasks. The prevailing wisdom in incentive design often advocated for linking pay directly to observable performance. The Informativeness Principle showed the value of utilizing all informative signals. The multitasking problem revealed a critical caveat: the relative informativeness and contractability of different tasks matter immensely. Holmström's multitasking model demonstrated that placing strong incentives on a task with a precise and easily contractable performance measure can inadvertently distort the agent's effort allocation, leading them to reduce effort on other tasks that are harder to measure yet valuable to the principal. For example, a teacher evaluated and compensated heavily based on student test scores might focus exclusively on test preparation, potentially reducing attention to broader educational goals like critical thinking, creativity, or social development, which are harder to quantify. A doctor incentivized purely on the number of procedures might spend less time on complex diagnosis, patient counseling, or preventative care. Holmström's unique solution involved analyzing the trade-offs inherent in multitask incentive design. He showed that optimal incentives require a delicate balance, aligning the strength of incentives for each task with the quality of the performance measure available for that task relative to the measures for other tasks. A key finding indicated that a performance on one task is much more precisely measurable than on another. Tying strong incentives to the precisely measured task will lead to a significant underprovision of effort on the poorly measured task. This implies that if a principal values both tasks, the incentive for the easily measurable task must be reduced to prevent this distortion, even if a more precise measure for that task exists. This can lead to a seemingly paradoxical conclusion. Sometimes, having a precise measure for one task makes it optimal to offer weaker overall incentives across the board to encourage a more balanced allocation of effort across all tasks, measurable or otherwise. The model highlights the principle of congruity. Incentives function best when the performance measures used are congruent with the true objectives of the principal across the entire range of tasks. When congruity is imperfect, Incentives tied to imperfect measures create distortions. The solution involves either improving the measures for the hard-to-quantify tasks, bundling tasks such that their measures are similarly informative, or attenuating incentives for the easily measured tasks to mitigate the distortionary pull. His analysis provided a rigorous explanation for why fixed salaries or less performance-sensitive compensation schemes might be preferable in roles where crucial aspects of performance are difficult to observe or measure. The modern relevance of the multitasking framework permeates organizational design and public policy. It informs compensation structures for complex jobs, emphasizing the need to consider the full spectrum of responsibilities, including those aspects difficult to quantify. In education, it fuels debates about the impact of high-stakes testing on teaching quality. In healthcare, it highlights concerns about payment systems that prioritize procedures, potentially neglecting patient outcomes or preventative care. In research and development, it explains how tying research or pay exclusively to patents filed can diminish the pursuit of fundamental, long-term investigations. The framework provides a powerful analytical tool for identifying potential incentive distortions and designing more holistic performance evaluation and compensation systems that encourage a balanced allocation of effort across all valuable tasks. It underscores a profound challenge of aligning private incentives with organizational goals when performance is multidimensional and measurement capabilities vary significantly across dimensions. This body of work addressed the dynamic complexities inherent in real-world work environments, where agents navigate multiple responsibilities and information unfolds over time, building upon earlier analyses of static, single-task problems. The natural progression of this inquiry led to exploring how future prospects and the market's evolving perception of an agent's capabilities shape current behavior, irrespective of explicit contractual incentives. This line of thought opened the door to understanding the powerful role of reputation in career concerns. The exploration of incentives within firms and other organizations naturally encompasses dynamic considerations, building upon analyses of static problems and the complexities of multitasking. A crucial dimension emerges when considering the passage of time and how information about an agent's capabilities accumulates and influences their future prospects. The market for talent, whether internal to a large corporation or the broader external labor market, constantly processes signals derived from observed performance. This dynamic learning process gives rise to powerful implicit incentives, shaping behavior irrespective of explicit performance-contingent compensation. A central challenge in understanding these dynamics involved articulating precisely how an individual whose underlying ability remains unrevealed to potential employers or clients would behave when their observed performance provides a noisy, imperfect signal of that ability. How does the prospect of future employment opportunities and the associated compensation, which hinges upon the market's evolving perception of one's competence, motivate effort in the present? The prevailing models often focused heavily on explicit contracts, leaving a significant gap in explaining the drive observed in many professional settings where performance proves difficult to measure directly and future career trajectories loom large. Bengt Holmström addressed this gap with his seminal work on career concerns. His unique solution provided a formal, rigorous framework for understanding how a rational agent seeking to maximize their lifetime earnings would strategically exert effort to influence the market's belief about their ability. The model posits an agent possessing an intrinsic, fixed level of ability, unknown initially to the labor market. The agent's performance in any given period is a function of this inherent ability, the effort they choose to exert, and a random shock or noise term. The market, observing the agent's performance, uses this information to update its probabilistic assessment, often framed within a Bayesian learning framework of the agent's true ability. Future wages are then determined by the market's updated, expected value of the agent's ability. The core insight of the career concerns model lies in recognizing that even if current effort proves difficult to observe directly or contract upon, and even if current performance bears heavy influence from noise, the agent possesses a powerful incentive to exert effort. This incentive stems from the impact of current performance on the market's belief about ability, which in turn affects expected future wages. Higher perceived ability translates into better future job offers and higher pay. Therefore, the agent invests effort today as a means of signaling high ability to the market, an investment aimed at enhancing their value in the future labor market. Consider the mechanics more closely. The agent understands the market's learning process. They know that a higher observed performance will lead the market to revise upwards its estimate of their ability. While they lack the capacity to change their inherent ability, they can influence performance through effort. The model demonstrates that the agent will choose an effort level that balances the utility of exerting effort against the expected future benefit derived from a potentially improved market perception of their ability. The noisier the performance measure, the less sensitive the market's belief updating is to any single period's outcome, potentially dampening the career concern incentive. When performance is seen as a relatively clear indicator of underlying talent, the incentive to signal through effort becomes stronger. A particularly insightful prediction of the model concerns the dynamics of incentives over a career. Early in an agent's career, there is significant uncertainty about their true ability. The market's beliefs are relatively diffuse. Consequently, early performance has a larger impact on the market's updated belief about ability than performance later in a career, when many observations have already narrowed the range of likely ability levels. This suggests that career concerns are often strongest for younger workers or those new to a particular role, as their performance carries more weight in shaping their long-term reputation and future earnings potential. As an agent matures in their career and the market's belief about their ability converges, the marginal impact of current performance on the market's assessment diminishes, potentially leading to a weakening of career concerns unless other incentive mechanisms are introduced. The framework provides a compelling explanation for high effort levels observed in professions where explicit pay-for-performance schemes are difficult or undesirable. Think of academics striving for publications and citations, lawyers working long hours on complex cases, or doctors building a reputation for diagnostic skill. In these fields, direct, quantifiable output measures capture a limited portion of valuable activity, and outcomes are often subject to considerable random factors. Professionals in these areas are typically highly motivated. The career concerns model posits that a significant driver of this motivation is the implicit incentive to build and maintain a strong professional reputation, which is crucial for attracting students or grants, securing partnerships, or being selected for prestigious positions. The model also sheds light on internal labor markets within large organizations. Employees often compete for promotions and more senior roles. Their performance provides signals to internal decision makers about their potential. The desire to be promoted, which represents an improvement in future career prospects and compensation, acts as a powerful career concern, motivating effort even when current tasks lack a direct tie to explicit bonuses. This mechanism holds particular importance for managerial roles, where performance is multifaceted and often difficult to attribute solely to the individual manager, while perceived competence heavily influences progression to higher leadership positions. Understanding career concerns is fundamental to comprehending the full spectrum of incentives operating within modern economies. It highlights the significance of factors beyond compensation packages and explicit contracts. Implicit incentives, driven by the market's ongoing assessment of talent and the value of reputation, play a profound role in shaping individual behavior, influencing effort levels, and contributing to productivity. This perspective underscores the importance of transparency, feedback, and clear paths for advancement within organizations, as these elements can strengthen the signaling mechanism and amplify the positive motivational effects of career concerns. The model reveals an endogenous source of incentives arising purely from the dynamics of information and market learning, providing a powerful lens through which to view the functioning of labor markets and the drivers of individual achievement in knowledge-based professions. This dynamic perspective, recognizing that incentives unfold over time and are shaped by evolving perceptions, paves the way for further inquiry into the nature of economic relationships, where explicit contracts are inherently incomplete and long-term interactions rely on trust, reputation, and the structure of property rights. This realm encompasses the formal handshake of a written agreement and the implicit understandings and power dynamics of ongoing interaction, presenting a profound challenge to standard economic models. How do parties cooperate and invest when they find it impossible to foresee, describe, and legally enforce every future contingency? This fundamental question underlies the study of relational contracts and the very boundaries of the firm. The problems of the time encompassed more than the individual agent within a clear contractual framework. They encompass the complex web of relationships between firms, between divisions within a firm, and between a firm and its suppliers or customers. Traditional economic theory often assumed complete contracts, agreements that perfectly specify every party's obligations and rights in every possible future state of the world. While a useful abstraction for certain analyses, this assumption strains credulity when applied to real-world business interactions, particularly those involving long-term commitments, unique assets, or rapidly changing environments. The sheer cost and cognitive burden of writing such a contract are prohibitive. Furthermore, even if one could write it, verifying whether a party had fulfilled their obligations in some distant, unforeseen future state would be exceedingly difficult or unachievable for a court or third-party enforcer. This incompleteness means that significant aspects of the relationship find governance through informal understandings, trust, and the anticipation of future dealings, which economists term relational contracts. A related, enduring puzzle concerned the boundaries of the firm. Why do firms exist? Why do some activities happen within the hierarchical structure of a single company termed make, and other activities are conducted through market transactions between separate entities termed buy? This is the classic make or buy decision, central to corporate strategy and organizational economics. Early insights, such as Ronald Coase's transaction cost theory, suggested that firms emerge when the costs of using the market, discovering prices, negotiating contracts, enforcing agreements, exceed the costs of internal organization. Coase's framework provided insights, and critical questions remained regarding the internal workings of the firm and precisely how contractual difficulties at the boundary influence the decision to integrate or outsource. The challenge lay in developing a rigorous framework that linked the micro-level problems of incomplete contracting to the macro-level structure of industries and the optimal scope of the firm. Holmström, often in foundational collaborations, particularly with Oliver Hart, provide a unique and powerful lens through which to understand these issues. Their approach centered on the pivotal role of property rights, the allocation of ownership and control over assets, in shaping incentives within relationships characterized by incomplete contracts. The core insight is elegantly simple yet profoundly impactful. When contracts are incomplete, the parties retain residual control rights. These are the rights to decide what happens to the assets and the relationship in all the states of the world that remained outside the explicit coverage of the contract. The allocation of these residual rights, determined by who owns the assets, becomes a crucial mechanism for providing incentives, especially for specific types of investments. Consider a scenario involving two parties engaged in a long-term relationship, perhaps a manufacturer and a specialized supplier. Both parties might need to make investments that are highly valuable within this specific relationship, but lose much of their value if the relationship dissolves. These are known as relationship-specific investments. The manufacturer might invest in specialized tooling. The supplier might invest in unique training for its workforce or dedicated production lines. If contracts were complete, they could specify exactly how the gains from these investments would be shared in every possible future state, ensuring both parties are incentivized to invest optimally. However, with incomplete contracts, there is a risk of holdup. After one party makes a specific investment, the other party might try to renegotiate the terms of the relationship to capture a larger share of the surplus created by that investment, knowing the investor faces limited profitable alternatives for their specialized asset. Anticipating this, parties may underinvest in relationship-specific assets, leading to economic inefficiency. Holmström's work, building on and formalizing the property rights theory of the firm developed with Hart, demonstrated how the allocation of ownership mitigates this underinvestment problem. The theory posits that giving ownership of the assets to the party whose relationship-specific investment is most important and most difficult to contract upon provides them with stronger incentives to invest. By owning the assets, that party secures the residual control rights. In unforeseen circumstances, they have the power to make decisions about the use of the assets, influencing the division of the surplus generated by the relationship. This prospect of controlling the upside in unspecified contingencies encourages them to make the necessary specific investments. For example, if the supplier's investment in specialized machinery is highly critical and difficult to specify fully in a contract, perhaps because its effective use depends on complex effort difficult or impossible to verify, giving the supplier ownership of the machinery provides them with the residual control rights over that asset. This ownership reduces the manufacturer's ability to hold up the supplier after the investment is made, thereby strengthening the supplier's incentive to invest optimally. If the manufacturer's investment in, say, a specialized design is more crucial and harder to contract upon, manufacturer ownership of the relevant intellectual property or physical assets would be predicted to yield better investment incentives. This property rights framework offered a rigorous explanation for the boundaries of the firm. The decision to integrate an activity, bringing it within the firm's ownership structure, can be seen as a means of allocating residual control rights. If the firm's own relationship-specific investments are paramount, owning the assets involved in the activity provides the necessary incentives. If the external supplier's investments are more critical, maintaining an arm's length relationship where the supplier owns the assets might be preferable. The theory predicts that firms will integrate activities where internal investments are particularly sensitive to hold up problems arising from contractual incompleteness. The implications of this work are far-reaching and continue to shape modern economic thought and business practice. It provides a foundational understanding of why mergers and acquisitions occur, often driven by the need to integrate assets and allocate residual control rights to facilitate relationship-specific investments and overcome contractual hurdles. It informs strategic decisions about outsourcing and the design of complex supply chains, highlighting how the structure of ownership impacts the incentives of different players in the value chain. The theory illuminates the economics of joint ventures and strategic alliances, explaining how shared ownership structures attempt to align incentives when partners must make interdependent relationship-specific investments. Furthermore, this perspective underscores the economic significance of trust and reputation, viewing them as crucial complements to formal contracts and facilitating long-term relationships. The property rights theory focuses on the allocation of formal control, the value of the ongoing relationship itself. The relational contract element provides additional incentives. The prospect of losing future profitable interactions serves as a powerful enforcement mechanism for implicit understandings and encourages parties to behave reliably, even in situations beyond the scope of explicit terms. Holmström's work on career concerns, discussed previously, resonates here. An individual's reputation and the market's perception of their quality become valuable assets, creating incentives for good behavior within relational contracts. The interplay between formal property rights and informal relational dynamics provides a rich framework for understanding the complex architecture of modern firms and markets. This work presents firms as intricate networks of incomplete contracts and power relationships shaped by the allocation of ownership, offering a perspective richer than simplistic views of firms as production functions or black boxes. This body of work demonstrates how fundamental issues of control and asset ownership are deeply intertwined with the ability to generate cooperation and investment in a world where comprehensive agreements are an impossibility. It is a testament to the power of economic theory to illuminate real-world organizational structures and strategic choices by focusing on the subtle yet profound consequences of information imperfections, and contractual limitations. This understanding of how incentives operate within and between organizations, particularly where formal mechanisms fall short, sets the stage for examining even broader systemic issues, such as the stability of financial systems where relationships or complex information is asymmetric and the cost of failure is immense. Building upon the insights into the intricate dance of incentives and information within organizations, Bengt Holmström turned his penetrating gaze towards an even broader, more complex landscape of the financial system itself. Financial markets, at their core, represent vast networks of relationships built on promises and expectations about future value. These relationships are inherently fragile, susceptible to the same informational frictions that plague individual firms, yet operating on a scale where failures can cascade with devastating global consequences. The problems he confronted here were fundamental. How do financial systems generate the essential lubrication of liquidity? What makes this liquidity evaporate during crises? And how does the asymmetric distribution of information throughout the system amplify systemic risk? Prior economic thought often viewed financial crises through lenses focused on macroeconomic imbalances, asset bubbles, or perhaps bank runs driven by simple coordination failures. While valuable, these perspectives frequently offered a limited microfounded understanding of the financial system's internal plumbing, the contractual arrangements and information flows that determine its day-to-day functionality and its susceptibility to sudden breakdowns. There was a pressing need for a rigorous framework that could explain how the very mechanisms designed to facilitate lending and investment could, under stress, become conduits for contagion and collapse. Holmström, often in seminal collaboration with Jean Tirole, provided precisely such a framework, developing a powerful theory of liquidity grounded in the economics of information and contracts. Their unique solution centered on understanding liquidity as a dynamic property generated by the financial system itself, a concept extending beyond viewing it as a mere stock of readily available cash. This liquidity arises from the ability of agents to pledge future income or asset value to secure funding today. The crucial insight lay in recognizing that this pledgeability is fundamentally limited by information problems. Lenders extend credit based on their beliefs about the value of assets or the future cash flows generated by borrowers. When lenders possess imperfect information about these values or cash flows, they become hesitant to lend, particularly against assets whose true worth is difficult to verify or observe. Central to their analysis stood the concept of collateral. Collateral serves a dual purpose. It provides security for the lender, offering recourse should the borrower default. Equally important, it acts as an information conveying mechanism. The quality and verifiability of the assets offered as collateral signal information about the borrower and the underlying project. Moreover, the ability to pledge an asset generates pledgeable income, the maximum amount of future income associated with the asset that can be credibly committed to repaying debt. The extent of this pledgeable income depends critically on how transparent and verifiable the asset's returns are to external parties. Assets with easily observable and verifiable returns generate high pledgeable income and serve as excellent collateral, readily facilitating lending and creating liquidity. Assets with opaque or unverifiable returns generate low pledgeable income, limiting the ability to borrow against them. This framework offered a profound reinterpretation of how liquidity is created within the financial system. It arises endogenously from the structure of financial contracts and the information environment. Banks, for instance, transform illiquid long-term assets like loans into liquid short-term liabilities like deposits or other forms of funding by leveraging their ability to monitor borrowers and manage information. A system's overall capacity to generate liquidity depends on the aggregate amount of pledgeable income available across the economy's assets. This perspective emphasized the critical role of credit markets, asset quality, and information flows in determining the system's effective liquidity, providing a more comprehensive view than simplistic notions of money supply. Applying this lens illuminated the deep roots of financial crises. A crisis, in this view, often represents a sudden, system-wide collapse in the perceived pledgeable value of assets. This can be triggered by new information revealing that asset values were lower than previously believed, or by heightened uncertainty that makes verifying asset values prohibitively difficult or costly. As lenders lose confidence in the collateral backing loans, they cease to be willing to roll over short-term funding or extend new credit. This drying up of credit forces borrowers to sell assets rapidly, often at fire sale prices, further depressing perceived values and eroding collateral for others. A vicious cycle ensues, where illiquidity feeds insolvency and information asymmetry leads to a breakdown of trust across the system. The problem becomes one of coordination. Even solvent institutions can fail if they find funding inaccessible because potential lenders fail to distinguish them from insolvent ones, or because the system-wide scramble for liquidity destroys even sound asset values. Their theory provided a compelling rationale for interventions typically seen during financial panics, particularly the role of a lender of last resort. In a crisis characterized by a collapse in pledgeable income and a coordination failure among private lenders, a central bank or government possesses unique capabilities. It can often access or aggregate information more effectively, helping to distinguish between illiquidity and insolvency. Although this remains challenging, crucially, a central bank can create its own liquidity, printing money, which provides a form of ultimate liquidity that is unconstrained by the pledgeable value of private assets. By lending freely against a wider range of collateral or even against impaired assets during a panic, The central bank can restore confidence, halt the fire sale dynamic, and safeguard the real economy from destruction by the collapse of pledgeable income. This intervention addresses the systemic nature of the problem, providing a public backstop when private mechanisms for generating and maintaining liquidity fail. However, their work also underscored the inherent moral hazard introduced by such backstops, creating a delicate balance for policymakers. The modern relevance of this work resonates powerfully in the aftermath of the 2008 global financial crisis. That event starkly demonstrated the fragility of liquidity in complex financial systems built on opaque assets and interconnected balance sheets. The rapid evaporation of funding for institutions holding mortgage-backed securities and related instruments appearing valuable yet ultimately lacking verifiability aligned precisely with the mechanisms described in Holmström and Tyrrell's framework. The crisis was a crisis of pledgeable income, where the informational opacity of structured finance destroyed confidence in collateral and froze credit markets. Their insights had directly informed the extensive regulatory reforms implemented since 2008 aimed at enhancing financial stability. Measures such as increased capital requirements for banks, reducing reliance on fragile short-term funding, stricter liquidity regulations requiring banks to hold more high-quality, easily pledgeable assets, and enhanced oversight of over-the-counter markets, improving transparency and reducing counterparty risk all reflect an understanding of the financial system as a network whose stability depends on the quality of information and the robustness of its liquidity-generating mechanisms. Central banks' innovative and extensive interventions during and after the crisis, including vast liquidity provision and asset purchase programs akin to acting as a market maker of last resort, drew justification, at times implicit and at times explicit, from the theoretical understanding that systemic liquidity requires a public response capable of restoring pledgeability and confidence. The debate continues regarding the optimal design of financial regulation and the appropriate scope of central bank intervention. Holmström's work provides a sophisticated theoretical foundation for this debate. It directs discussions toward the deep structural vulnerabilities created by information asymmetry and contractual incompleteness within the financial architecture, offering a more profound analysis than superficial exclamations of greed or irrationality. It highlights that financial stability is achievable only through careful attention to the micro-level incentives and information flows that govern lending and borrowing relationships, understanding that these micro-level issues can aggregate into macro-level systemic risks. This perspective on the financial system, emphasizing endogenous liquidity and the critical role of information-sensitive collateral, represents a cornerstone of modern financial economics and a powerful lens through which to analyze the perpetual challenge of maintaining stability in a world of complex, interconnected, and informationally imperfect financial markets. It reveals how the fundamental problems of contracting and information that shape individual firms extend to define the very stability of the global economy, setting the stage for broader consideration of how these core principles unify diverse areas of economic inquiry. The insights derived from analyzing information asymmetry and contractual incompleteness within the financial architecture serve as a powerful microcosm for understanding the broader scope and profound unity of Bengt Holmström's intellectual project. His exploration of how micro-level incentives and information flows shape lending and borrowing relationships, and how these dynamics aggregate into macro-level systemic risks, reveals a fundamental perspective that permeates his entire body of work. Stability within the financial system, from this viewpoint, becomes intrinsically linked to the careful design of agreements and institutions that acknowledge and manage informational imperfections. He demonstrated how the concept of endogenous liquidity and the critical role of information-sensitive collateral illuminate the perpetual challenge of maintaining equilibrium in complex, interconnected markets characterized by incomplete information. This lens applied to finance mirrors the analytical approach he championed across diverse economic domains. The central thread weaving through Holmström's extensive contributions resides in his relentless, rigorous examination of economic relationships viewed through the prism of information problems. He approached the vast landscape of economic interactions, whether between an employer, an employee, a principal, and agent, a firm, and its investors are lenders and borrowers, by asking a core question: what are the consequences when parties possess different information, and how do optimal arrangements emerge in response to these disparities? Holmström's analysis centered information asymmetry and its consequences. Earlier economic models frequently assumed perfect information or considered information problems minor impediments. Holmström placed information, its asymmetry, and the resulting incentive conflicts at the very heart of economic analysis. His work on agency theory, for instance, provided a foundational framework for understanding the complexities inherent in delegation. The problem is simple to state: how does a principal like a firm owner motivate an agent like a manager or employee to act in the principal's best interest when the agent's actions or the environment they operate within are imperfectly observable to the principal? Holmström's seminal papers introduced formal models that precisely characterized this challenge. He showed how compensation schemes, such as those linking pay to performance measures, serve as crucial tools to align incentives. His informativeness principle demonstrated that any performance measure providing additional information about the agent's effort, even if noisy, should be incorporated into the compensation contract to improve incentive alignment. This seemingly abstract principle has had massive implications for how executive compensation is structured, how performance is evaluated within firms, and how contracts are written across a multitude of industries. Extending this logic, his analysis of multitask agency problems revealed a deeper layer of complexity. An agent handling multiple tasks encompassing easily measurable activities like sales figures alongside those harder to measure, such as building client relationships or contributing to team culture, faces potential incentive distortion from contracts based solely on easily measurable outcomes. Agents naturally concentrate effort on measurable tasks. This leads to insufficient attention for activities harder to measure despite their potential for equal or greater significance. Holmström's formalization of this problem highlighted the inherent trade-offs in contract design and the limitations of performance-based pay when the full spectrum of desired behaviors elude adequate capture by objective metrics. This provided a powerful theoretical explanation for phenomena observed in organizations, from the neglect of crucial but unquantifiable aspects of the job to the challenges of motivating innovation, which often involves activities with uncertain and delayed outcomes. These insights into individual contracts and agent behavior scaled up seamlessly to inform his work on the theory of the firm in corporate governance. The very existence and boundary of the firm, from this perspective, are shaped by information, costs, and contracting challenges. Why are some activities conducted within a firm's hierarchy while others are outsourced through markets? Holmström's work contributed to understanding the firm as a structure designed, in part, to mitigate information problems inherent in market transactions. Within the firm, the relationship between owners, principals, and managers, agents, and between managers and employees is rife with informational challenges. His analysis illuminated the role of corporate boards, capital structures, and internal organizational design as mechanisms aimed at aligning the incentives of various stakeholders when information is dispersed and asymmetric. He helped formalize the idea that the financial structure of a firm, its mix of debt and equity, impacts incentives and behavior, particularly in situations involving potential financial distress or investment decisions under uncertainty. The application of this information-centric lens to financial markets, as discussed previously, then closed a crucial loop. Financial contracts, like loans and equity agreements, are fundamentally arrangements designed to allocate risk and reward over time, often in situations where borrowers have superior information about their projects or ability to repay than lenders do. The value of collateral, the structure of debt covenants, the role of financial intermediaries as information gatherers and monitors, all these elements could be rigorously analyzed as responses to information asymmetry and the desire to create incentives for efficient behavior and repayment. His work underscored that financial crises frequently originate from the breakdown of these information-sensitive mechanisms, leading to cascading failures of trust and liquidity. What unites these seemingly disparate areas, executive compensation, multitasking, firm boundaries, corporate finance, and financial stability, is a singular, powerful analytical framework. Holmström provided the tools and the conceptual clarity to view all these economic phenomena as variations on a theme. This theme involves the design of institutions and contracts to manage incentives and allocate risk effectively in a world where information is imperfect, costly to acquire, and unevenly distributed. His approach featured a deep commitment to formal modeling, employing mathematical precision to clarify complex situations, revealing the core informational challenge and the properties of the optimal response. This mathematical rigor ensured that his insights were sharp, logically sound, and capable of generating testable predictions. The enduring legacy of Bengt Holmström is multifaceted. He proved instrumental in establishing contract theory as a distinct and central field within economics, building upon its origins in specific problems. He provided the foundational models and the intellectual agenda that subsequent generations of economists have built upon. His work reshaped how economists think about organizations, incentives, and financial systems, highlighting the crucial role of micro-level details concerning information flow and contractual design as determinants of macro-level outcomes and institutional form. His insights have permeated academic research and practical applications alike, influencing the design of compensation systems in corporations, the regulation of financial markets, and the understanding of governance structures across various organizations, encompassing private firms and public institutions. His influence encompasses specific models and a fundamental way of thinking. He instilled in the field an appreciation for the power of simple, elegant models to illuminate complex, real-world problems. He showed that understanding the precise nature of the information asymmetry at play is the critical first step in designing effective economic arrangements. His work stands as a testament to the power of abstract theoretical reasoning to yield profound and practical insights into the fundamental workings of the economy. Looking forward, the relevance of Holmström's work appears poised for continued growth in an increasingly complex and interconnected global economy characterized by rapid technological change and the proliferation of information. The problems of managing incentives, dealing with information overload, and designing robust institutions remain paramount. The rise of digital platforms, the gig economy, Decentralized finance and complex global supply chains all present new variations of the core information and incentive problems that Holmström dedicated his career to analyzing. His framework provides an essential lens through which to understand the challenges and opportunities presented by these developments. How do smart contracts manage information? How do platform algorithms shape incentives for workers and consumers? How does the transparency or opacity of new financial instruments impact systemic risk? These questions are direct descendants of the intellectual agenda he pioneered. Bengt Holmström provided economics with a powerful, unifying perspective. He revealed that beneath the surface, diversity of economic phenomena lies a common set of challenges related to information and incentives. By providing the conceptual tools and the analytical rigor to tackle these challenges formally, he equipped economists with a framework capable of dissecting complex problems and designing more effective institutions. His legacy encompasses a collection of important papers and models, representing a fundamental shift in how the profession understands and approaches the study of economic interactions. This shift continues to shape research, policy, and practice in the 21st century. His work stands as a towering achievement in the quest to understand the intricate dance between information, incentives, and the design of the economic world around us.
We really appreciate you tuning into this AI-powered presentation. Our goal is to push the boundaries of AI in content creation, and your input is invaluable. If there's a particular subject you'd like to see us tackle next, or if you have suggestions on how we could fine-tune our AI's creative prompts, please don't hesitate to leave your ideas in the comments section. We're excited to bring you more unique content very soon.